Welcome back to Squawk Box. The Fed's two-day policy meeting kicking off today. Our own senior economics reporter, Steve Liesman, joins us now with the results of CNBC's latest Fed survey ahead of the big number. Will it be 25 basis points? Will it be 50? What do you say, sir?
Yeah, well, Andrew, I don't know if this helps anybody, but respondents to the CNBC Fed survey coming to a more gradual conclusion about the outlook for Fed rate cuts both at this meeting and down the road, adding to the almost unprecedented uncertainty over what the Fed is going to do just a day ahead of what is widely thought to be the first rate cut in more than 4 years. Here are the Fed expectations from the survey. 96% say the Fed's going to cut. That's the easy part. But 84% say the Fed is going to cut by 25 basis points. That compares with that 65% probability of a 50 in the futures market. 3.7% is the 2025 year-end funds rate, almost a percentage point higher than the market has priced in. And 3.3% is the news rate, just a little bit higher than it's been. Even when asked what the Fed should do, 56% say it should cut by 25 bips. Now, here's the difference between the Fed survey and the market. 5.4 is the starting point. Survey says we get down to 4.6 by year end. Market says 4.1. Survey says 3.7 into 25. Market says 2.8, so almost a percentage point difference in how aggressive the rate cutting is. Commenting on this aggressive pricing in the market, John Donaldson of Haverford Trust writes into the survey, "We believe that the equivalent of 8 cuts in 6 meetings is more than what will happen. That forecast is more in line with a hard landing than a soft landing." The 27 respondents, they include economists, fund managers, and strategists, on average don't forecast the economy is going to weaken, or at least weaken as quickly, and think the Fed can take its time. Mike England of Action Economics writes in, says, the economy is growing faster than expected in 2024, and the Fed has time to lower rates at a measured pace. That statement is backed up when we asked essentially if the Fed is behind the curve. 74% said the September cut comes in time to preserve a soft landing. 15% say it's too late. 11% think it's actually too early. Forecasts for the unemployment rate did tick modestly higher. Growth, a couple ticks lower. Both, however, are in line with what you might consider a soft landing scenario, not a recession. So the difference seems to center on a market view of a weaker economy both now and in the months ahead, and the view of forecasters that the market pricing has more urgency than is warranted by the data. Andrew?
Steve, what I can't figure out is if you get 50 basis points tomorrow, which now it seems like the markets are expecting or want or something, does everybody breathe a sigh of relief, or do they say, oh, my goodness, maybe things are worse than we thought?
There is the panic scenario or the idea that this ends up creating some panic out there. Depends a lot upon the communication. The Fed is reasonably good at this. They can sell it a little bit like, hey, it's a down payment on where we need to go. I think the problem is that difference, Andrew, when you look at the difference in the market pricing versus what the survey says, right. The market's very aggressive in getting the Fed within a year's time, essentially, down to the neutral rate. I think a 50 might even cause that to go even further. So it kind of picks up your idea that there would be some panic, a sense that, hey, we're doing 50 now. Maybe the new step is 50s, not 25s.